Welcome to Cost Saver Conversations. I'm Angela, and I ask the practical questions so you can quickly understand what matters. Today, I'm joined by Assad.
Hi, Angela. We are unpacking company car versus cash allowance in the UK, hidden tax implications and cost pitfalls for 2026 today, and tying it back to the wider cost saver ecosystem, including tools like company car BIK versus cash allowance calculator and BIK versus cash allowance comparison tool, so you can turn insights into action quickly.
Just a heads up before we dive in, we are your synthetic hosts. We are great with numbers, but as AI, we can sometimes be confidently wrong. Think of us as the digital versions of your most knowledgeable, slightly caffeinated friends.
Exactly. Treat this chat as a smart estimate only, not as professional financial guidance. Always check important details with official sources or a qualified expert before making any big decisions.
Hello and welcome back to the Cost Saver podcast. Today, we are tackling something that, honestly, I think a lot of people just sort of sleepwalk through, the company car versus cash allowance decision. And it's getting way more complicated than it used to be. Assad's here to help us make sense of it all.
Hey, Angela. Yeah, this is one of those topics where people think they already know the answer, right? Like, oh, my mate Dave took the cash, so I'll take the cash. But for 2026, that kind of thinking can genuinely cost you thousands. The landscape has shifted quite a lot.
Thousands? Okay, so give me a range. How much are we actually talking about here?
So the difference between the right and the wrong choice can quietly cost you between 1,200 and 3,500 pounds a year, depending on your tax band and the actual vehicle on the table.
Wait, really? That much?
Yeah, and that's not a one-off. That's every year you're in the scheme. So over a 3-year contract, you could be looking at, 5 figures of difference, which is kind of a lot.
That's wild. So what's changed? Why is 2026 suddenly the year everyone needs to pay attention?
Okay, so there are a few things happening at once. The big one is electric vehicles. For years, EVs were basically tax-free as company cars, right? The benefit in kind rate was sitting at 2%, but now it's climbing 1 percentage point every year. And the vehicle excise duty exemptions for EVs? Gone. Just gone.
Oh, I didn't realize the VED exemption had been removed.
Yeah, that catches a lot of people out. And then on top of that, insurance premiums have they've shot up across the board. And here's the one that really gets me. HMRC's approved mileage allowance payment rates, the 45p per mile for the first 10,000 business miles, that hasn't been refreshed in years, even though the actual cost of running a car has gone up considerably.
So all the old rules of thumb are basically...
Out of date, yeah. Whatever your colleague told you in the car park 2 years ago probably doesn't hold anymore.
Right. And there's a time pressure element too, isn't there?
There is. If your new tax year starts in April and you're still umming and ahhing, you could be locked into the wrong choice for at least 12 months. Most schemes won't let you switch mid-year. So before you sign anything, you want to get the exact P11D value and the BIK percentage of the car from HR in writing. Because a 1% difference in the BIK band on a $45,000 car costs a 40% taxpayer an extra $180 a year. And dealer brochures are often out of date by the time you're actually signing.
That's a really good tip. Okay, so for people who aren't familiar with all these terms, BIK, P11D, can you just walk us through how company car tax actually works?
Yeah, sure. So a company car is what HMRC calls a benefit in kind. You're not getting cash for it, but it has personal value, so the tax man wants a slice. The calculation is, honestly, it's simpler than people fear. You take the car's list price, which is the P11D value, multiply it by the BIK percentage band, that depends on CO2 emissions and fuel type, and that gives you your taxable benefit. Then you just pay your income tax rate on that figure.
Okay, give me a quick example.
Right. So a $40,000 car, 10% BIK rate. 40,000 times 10% is $4,000. That's your taxable benefit. If you're a 40% taxpayer, you pay 40% of that, which is $1,600 a year. That's it. Does that make sense?
Yeah, actually much clearer than I expected. And EVs are still the best option for this, but the gap is narrowing.
Yeah, exactly. Pure electric BIK rates started at 2% and they're on that gradual climb. Petrol and diesel are way higher, often between 25% and 37% depending on emissions. So EVs are still the winner by a long shot. But, and this is the thing, if you're picking a company car in 2026, go pure electric over plug-in hybrid. PHEV BIK bans depend heavily on electric-only range, and the rules are being tightened. A PHE that looks great on paper can jump into a much higher band if its zero-emission range gets reassessed.
I know a lot of people who went for PHEVs thinking they were getting the best of both worlds.
Yeah, and some of them are getting a nasty surprise. It's just one of those things, you know?
What about fuel and charging? Is that all covered under the company car?
So if your employer pays for your private fuel as well, that triggers a separate car fuel benefit charge. And it's almost always poor value unless you do absolutely enormous private mileage. For EVs, though, employer-provided workplace charging is currently free of BIK, which is nice. And business mileage in a company EV uses HMRC's advisory electricity rate, updated quarterly. But, and this trips people up, if your employer reimburses you above that advisory rate, the excess is taxable. So keep clean mileage records and check the rate each quarter.
Okay, noted. So that's the company car side. Now, the cash allowance, that sounds wonderfully simple, right? Just extra money in your salary?
It sounds simple, but that simplicity is mostly an illusion. So let's say you get $6,000 a year. That's treated as normal employment income, taxed at your marginal rate, national insurance on top. A 40% taxpayer with that $6,000, they keep roughly $3,480 after tax and employee NI.
So you lose almost half before you've even...
Before you've even thought about a car, yeah. And from that $3,480, you've got to fund a lease, insurance, road tax, servicing, tires, depreciation. Suddenly, it doesn't go very far.
Right. And depreciation, you called that the silent killer earlier?
Yeah, I mean, a new $35,000 car can lose between $8,000 and $12,000 in its first year. A lease smooths that out in the monthly payments, but if you buy outright or on finance, you're absorbing that hit directly. And a company car driver, they bear zero depreciation risk, none. That's a massive hidden benefit people just forget about.
And then there's insurance, which is, that's been in the news a lot lately.
Oh, absolutely. Personal car insurance with business use is a completely different beast to standard social, domestic, and pleasure cover. Premiums have risen sharply, and adding business mileage pushes them up even further. And here's the scary bit. A lot of people get a cheap quote from a comparison site that doesn't include business use at all. So the moment they drive to a client meeting, they're technically uninsured.
That's terrifying.
It is. If you take a cash allowance and use the car for any work travel beyond your normal commute, you need explicit business use cover. Don't assume your employer's liability protects you, because it usually doesn't.
Okay, so lots of hidden layers. Can you bring this to life with, like, a real-world example? Actual numbers?
Yeah, let's do it. So meet Priya, marketing manager from Reading, earns £72,000, firmly in the 40% tax band. She's offered either a £45,000 electric company car or a £7,000 annual cash allowance. She does 12,000 business miles and 8,000 personal miles a year.
Go on.
Company car route first. BIK band for 2026-27 is around 4%, so the taxable benefit is £1,800. At 40% tax, that costs her $720 a year. And her employer covers everything else: servicing, insurance, road tax, breakdown, depreciation, the lot.
$720 a year for a fully funded $45,000 car? That's pretty good.
It is. Now the cash route. Her $7,000 becomes roughly $4,060 after tax and NI. From that, she's paying about $400 a month for a personal lease. That's $4,800 a year. Then $900 for comprehensive insurance with business cover, $400 for servicing and tires, maybe $600 for home charging. Total, around $6,700. She's already $2,640 out of pocket, and that's before we even talk about mileage.
Ouch.
Yeah. Now, her employer pays 25p per business mile. On 12,000 miles, that's $3,000 back. And she can claim tax relief on the 20p shortfall versus HMRC's 45p rate. That recovers about $960 at 40% tax. But even with all of that, the cash allowance route still leaves her roughly $1,300 worse off. And that's ignoring depreciation risk if she'd bought instead of leased.
So, company car wins clearly for Priya, but I'm guessing it's not always that clear-cut.
No, not at all. Change that car to a high-emission petrol with a 35% BIK band, and the company car suddenly costs her $6,300 a year in tax. Cash allowance wins comfortably in that scenario. So the decision flips entirely based on the car you choose and your tax band. A 20% taxpayer choosing an EV and a 45% taxpayer choosing a diesel, they're playing completely different games.
Huh, fair enough. Now, you mentioned something called the gray fleet earlier. What is that exactly?
Right. So when you take a cash allowance and use your own car for business, you become part of what's called the gray fleet. And employers are quietly passing a stack of legal and duty of care obligations onto you. You're typically required to prove your car's roadworthy, has a valid MOT, has business use insurance, clean license. Some employers now run annual checks on all of this.
And if you don't keep it all up to date?
If you have an accident on a business journey and your documentation isn't in order, you could face personal liability claims. It's serious. So before accepting a cash allowance, ask your employer in writing what their gray fleet policy requires and what they actually reimburse. If they expect significant business mileage at 25p a mile in your own car, that's a poor deal in 2026, worth pushing back on.
That's really key advice. Now, is there a third option here? I've heard people mention salary sacrifice schemes.
Yes, and honestly, this is the one that's sort of quietly sitting at the top of the efficiency table for a lot of people. You give up a portion of your gross salary in exchange for an employer-provided car, usually electric. Because the sacrifice happens before tax and NI, you're effectively running the car with pre-tax money.
Oh, that's actually quite clever.
It is. You still pay BIK, but the saving on income tax and NI on the sacrifice salary usually outweighs the BIK charge by a wide margin. And for higher earners, particularly anyone losing their personal allowance between $100,000 and $125,140, salary sacrifice can be especially powerful because it brings your adjusted net income back below the taper threshold.
Okay, but there's a catch, right? There's always a catch.
There's always a catch. The main one is commitment. These agreements run 2 to 4 years typically, and early termination, redundancy, long-term sickness, leaving the company can trigger significant exit fees, so read the small print. Though, to be fair, most reputable providers now offer insurance products that cover redundancy and long-term sickness for a small monthly add-on.
Oh, that's actually reassuring. What about pensions, though? Does salary sacrifice mess with your pension contributions?
Good question. In most modern schemes, employer pension contributions are based on your full notional salary, including any sacrifice, so the impact is usually minimal. But, and I always say this, check your specific scheme rules. Don't just assume.
Right. Okay. So for someone listening right now thinking, this is a lot, what are the actual practical steps they should take?
Okay, so first, get the precise figures from your employer. P11D value, BIK percentage for the car, the cash allowance amount, and their business mileage reimbursement rate. Second, honestly estimate your real annual mileage and split it between business and personal. And I say honestly because most people overestimate business mileage and underestimate personal.
Guilty.
Everyone is. Third, price up a personal lease or finance deal for an equivalent car. Include insurance with business cover, servicing, tires, breakdown, all of it. Fourth, run both scenarios through a calculator. We've got one on the site that does it in under 5 minutes. And fifth, factor in flexibility and risk. A company car removes depreciation risk and admin. A cash allowance gives you freedom to pick any vehicle, including a cheaper used one. It's just, you have to weigh it all up for your specific situation.
And before we wrap up, what are the biggest mistakes you see people making?
Where do I start? The classic is comparing the gross cash allowance to the post-tax cost of a company car, like comparing $7,000 to $720 without accounting for the tax on the allowance. forgetting to include insurance business use loading, picking a high-emission petrol car because the BIK doesn't look too bad on paper, underestimating depreciation, and just not claiming mileage allowance tax relief through self-assessment. That's real money left on the table.
So the bottom line is there's no one-size-fits-all answer.
No. Look, in 2026, the balance has tilted heavily towards company cars for anyone choosing pure electric. Cash allowances still make sense for low-mileage drivers happy to run a modest used car. High-emission company cars are basically the worst of both worlds. And salary sacrifice EVs are quietly the most efficient option for most higher earners. But, and this is the thing, don't rely on your colleague's anecdote. Sit down with your actual numbers, your tax band, your real mileage, the specific car. A bit of careful math now can save you a four-figure sum every single year.
That is a brilliant place to leave it. Assad, thank you so much for making sense of all of that. Lots for everyone to go away and crunch. We'll see you next time.
Thanks, Angela.
Quick side note, this guide connects with other cost-saver blogs, especially UK tax optimizers versus traditional calculators, rent-a-room scheme profitability checklist, and free ways to cut energy bills this winter.
Exactly. And reading those together helps you connect the dots across your household budget, not just this one topic in isolation.
And if you want to apply this immediately, jump into tools like Company Car BIK versus Cash Allowance Calculator and BIK versus Cash Allowance Comparison Tool right after this episode.
Primary sources used here include HMRC, Tax on Company Cars, and HMRC Travel, so you can verify the data yourself and stay evidence-led.
That wraps this cost-saver conversation with Angela and Assad. If this helped, share it with someone who could put these ideas to work this week.
Your next step is simple. Try Company Car BIK versus Cash Allowance Calculator, then read UK Tax Optimizers versus Traditional Calculators, and use them together to take action today.